I warn you in advance, this will disappoint those looking for a crystal ball. I don't have one, never did, and I'll make mistakes in what follows, lots of them. The fundamental problem with market crashes and black swan events is that predicting them is impossible. Anyone who tells you they have a system for timing crashes is either stupid or lying, probably both. I've been in this game for 70 years. I've watched every mania, every panic, every clever scheme that promised certainty. And the one certainty is this: nobody knows when markets will crash. Nobody knows how severe crashes will be, and nobody knows how long recoveries will take. What I can offer instead is something far more valuable, a framework for surviving them. Not predicting, surviving. That's the entire game. Let me be clear about something else. I'm not here to promise you that these principles will make you rich. That's not the point. The point is keeping you from going broke. Because going broke is permanent. You can't compound from zero. You can't recover from catastrophic loss. You're finished. So the intelligent approach is designing your finances so that nothing can kill you. Not inflation, not crashes, not stupidity, yours or the market's. This isn't exciting. It won't sell newsletters. But it's the truth, and the truth is all I have to offer. I spent decades watching markets, studied every major crash from 1929 forward, the Great Depression, the 1973 to 74 collapse, the 1987 crash, the dot-com bubble, the 2008 financial crisis, the 2020 pandemic panic, and what becomes absolutely clear is this: the people who survive catastrophic market events share a few simple principles. Not complicated ones, simple. But simple doesn't mean easy. If it were easy, everyone would do it. They don't. And that's why most portfolios blow up when markets finally reveal their true nature, which is chaos interrupted by periods of calm, not calm interrupted by periods of chaos. You have that backwards if you think normal markets are the default state. Most people do. They experience 5, 10, 15 years of relatively calm markets with manageable corrections, and they start to believe that's normal. It isn't. That's the aberration. Chaos is the default. Markets crash. Companies fail. Geopolitical events disrupt everything. And these disruptions don't announce themselves politely. They arrive suddenly, violently, and they destroy anyone who wasn't prepared. Get that right in your head first, or nothing else will help you. The first question isn't, how do I profit from crashes? That's gambler thinking. That's greed masquerading as strategy. The first question, the only question that matters initially, is how do I survive them intact? Because if you can't survive, you can't compound. And if you can't compound, all the brilliance in the world won't save you. Genius without longevity is worthless. Mediocrity with survival beats genius with catastrophic mistakes. Every single time. I've watched this pattern repeat for 70 years. The brilliant people who blew up, the careful people who endured, and endurance won, always. Let me be brutally clear about what survival means mathematically, because most people have never actually run the numbers. They talk about crashes abstractly, emotionally, without understanding the arithmetic that governs recovery. Here it is. If your portfolio drops 50%, you need a 100% gain just to break even. Not 50%, 100%. That's not opinion. That's not my view. That's arithmetic. Elementary school mathematics that somehow adults forget when markets are involved. Think about what that means practically. You start with $100,000, market crashes, you're down to $50,000. To get back to $100,000, you don't need a 50% gain. You need to double your money. And doubling money, even in good markets, takes years. At 10% annual returns, doubling takes approximately 7 years. So a 50% drawdown costs you 7 years of compounding time just to break even, assuming you achieve 10% returns consistently, which most people don't. But here's the part that makes this devastating. The real cost isn't the mathematical recovery, it's the time cost. Those 7 years you spend recovering, that's 7 years you're not compounding forward. That's 7 years of opportunity cost. If instead of crashing 50% you'd stayed flat, you'd be 35 to 40% ahead after 7 years of compounding. So the true cost of a 50% drawdown isn't 50%. It's 50% plus 7 years of missed compounding. That could be 70, 80, 90% of potential wealth destroyed. One crash, one mistake, decades of wealth creation eliminated. And time is the one asset you absolutely cannot replenish. Lose capital, you might rebuild it if you're young enough and disciplined enough. Lose time, it's gone forever. This is why crashes are so devastating for people over 50 or 60. They don't have another 3 decades for compounding to bail them out of mistakes. One catastrophic drawdown and their retirement is destroyed. They're working into their 70s not because they want to, but because they have to. And it all traces back to not understanding the mathematics of survival versus the mathematics of optimization. Here's the part that makes this worse. Most crashes don't announce themselves as crashes initially. They arrive disguised as corrections, as temporary setbacks, as perfectly rational repricing events that financial media explains away with plausible narratives. The market's down 10%? That's healthy. Down 15%? Just a normal correction, happens every few years. Down 20%? Technical bear market, but fundamentals are strong. And you believe these narratives because you want to believe them. Because admitting it's a real crash means admitting you should have been more conservative. Admitting you took too much risk, admitting you were overconfident. By the time you recognize it's not a correction but a catastrophe, you're already down 30, 40, 50%. And at that point, your psychology is destroyed. You're not thinking rationally anymore. You're thinking emotionally. Should I sell now and preserve what's left? Should I hold and hope it recovers? Should I buy more because prices are attractive? You're paralyzed. And paralysis during crashes is how mediocre losses become catastrophic ones. Because you're not executing a plan. You're reacting emotionally. And emotional decisions in markets are wealth destruction machines. This is why the first principle of crash survival has nothing to do with markets. It has to do with mathematics and position sizing. It has to do with designing your portfolio before the crash, so that when chaos arrives, you're not making decisions under stress. You're executing a plan created when you were rational, calm, and thinking clearly. The decisions that destroy people are made during crashes. The decisions that save people are made before crashes, when nobody's panicking and clear thinking is still possible. The mathematics of survival starts with a simple question that most people never ask themselves honestly. Can you afford to be wrong? Not, will you be wrong? You will be wrong. I've been wrong. Warren's been wrong. Every investor who ever lived has been wrong repeatedly. That's not the question. The question is whether you've positioned yourself so that being wrong doesn't destroy you. Whether being wrong about one investment or 3 investments, or even 5 investments simultaneously, still leaves you with enough capital to continue compounding. This is where most people fail catastrophically before they even recognize they're at risk. They eliminate their margin of safety by concentrating positions, using leverage, or investing money they need in the near term. Any one of those 3 mistakes can destroy you. All 3 together guarantee it. And people make all three mistakes constantly because they confuse confidence with certainty. They find an investment they're confident about, and they translate that confidence into concentration. They're so sure it will work that they bet heavily, use leverage to amplify returns, invest money they'll need soon because the opportunity is too good to pass up. And then market reality arrives, which doesn't care about your confidence or your analysis or your need to be right. Position sizing is the most important decision you'll make as an investor. Not which stocks to buy, not when to buy them, how much of each position to hold. Get this wrong, and everything else becomes irrelevant. You can have perfect analysis, brilliant timing, and still get wiped out if you size the position wrong. Because position sizing determines whether mistakes are recoverable or catastrophic, whether you survive to compound or start over from zero. Here's the framework, and it's not complicated. No single position should represent more than 5 to 10% of your portfolio, maximum, ever. I don't care how confident you are in the analysis. I don't care how well you understand the business. I don't care if it's Apple at $50 or Berkshire at $5,000 or the greatest opportunity since Coca-Cola in 1920. 5 to 10% maximum per position. And if you're going to err on the side of smaller positions. 7% feels more comfortable than 10%. 5% safer than 7%. Conservative position sizing saved more fortunes than brilliant analysis ever created. Why these limits? Because you need to design the system to survive your own stupidity. And you will be stupid. Multiple times. Everyone is. The question is whether your stupidity kills you. If you're concentrated in 3 or 4 positions at 20 to 25% each, one catastrophic mistake ends you. The business commits fraud. The CEO dies unexpectedly. A competitor emerges with superior technology. A regulatory change destroys the business model. Doesn't matter what the specific catalyst is. What matters is that one position going to zero takes 25% of your wealth with it, and recovering from 25% drawdowns takes years, decades even. You don't get to compound anymore during recovery. You're rebuilding. And if you're over 50, you probably don't have time to rebuild. But if positions are sized at 5 to 7%, even complete failures are survivable. 5 positions go to zero, that's brutal. That's 25 to 35% of your portfolio gone. But you still have 65 to 75% remaining. You're damaged but not destroyed. You can still compound forward, still recover, still build wealth over time. The system survived your stupidity, and surviving your own stupidity is the whole game in investing. Let me give you an example from history that illustrates this principle brutally. Long-term capital management. I mention this not to embarrass anyone, but because the lesson is too important to ignore. LTCM was run by genuine geniuses, not smart people, geniuses, literal Nobel Prize winners in economics, brilliant mathematicians, people who understood probability, market structure, arbitrage opportunities better than virtually anyone alive. Their models were sophisticated. Their analysis was rigorous. Their strategies were based on sound mathematical principles. And they got completely, utterly, catastrophically wiped out. Why? Not because they were stupid. Not because their analysis was wrong. Because they used massive leverage and concentrated positions. They were positioned for brilliance, but not for survival. When markets moved against them in ways their models said were virtually impossible, they had no margin of safety. Their leverage amplified losses. Their concentrated positions meant they couldn't diversify the damage. And within months, a fund managing over $100 billion was insolvent. Needed a Federal Reserve orchestrated bailout to prevent systemic collapse. Geniuses with perfect analysis destroyed by position sizing and leverage. The lesson couldn't be clearer. Intelligence doesn't protect you from concentration risk. Position sizing protects you. Nothing else. The hardest part of position sizing isn't mathematical. The math is trivial. Fifth grade arithmetic. The hard part is psychological. When you find what you believe is an extraordinary opportunity, every instinct screams at you to bet heavily. Make a big score. Get rich quickly. Capture the full upside of your brilliant insight. These instincts will destroy you if you listen to them. Because even extraordinary opportunities can go to zero if you're wrong about something fundamental you didn't see. And there's always something you didn't see. Always. The unknown unknowns are what kill you, not the known unknowns. So you size positions for survival first, optimization second. Accept that you'll underperform during bull markets when your concentrated peers are making multiples of your returns. Accept that you'll look conservative, overly cautious, maybe even scared. None of that matters. What matters is surviving the inevitable crash intact with capital to deploy. Because the people who optimize for bull markets die in bear markets. And dead capital doesn't compound. Conservative position sizing feels like leaving money on the table during good times. But it's actually leaving you in the game for the long run. And the long run is where real wealth gets built. Now, let's talk about the most seductive and destructive belief in all of investing: market timing. The idea that you can get out before crashes arrive and get back in at the bottom. That you can dance in and out of markets, capturing upside while avoiding downside. This belief is pure fantasy, but it's persistent fantasy because the hypothetical payoff would be enormous if it were possible. It isn't possible. Not for you, not for me, not for anyone consistently over time. The people who claim they can time markets are either lying to you, lying to themselves, or both. Usually both. I need to be very clear about this because the temptation to time markets becomes overwhelming during volatile periods. When markets are elevated and you just know that a correction is coming. Or when markets crash and you're certain they'll fall further before bottoming. These feelings of certainty are not knowledge. They're emotional responses masquerading as analysis. And acting on them destroys wealth consistently and predictably. Here's what actually happens when you try to time markets, and I've watched this sequence play out thousands of times over 70 years. Markets become elevated, valuations look stretched, maybe some economic indicators flash warning signs. You decide to reduce positions, raise cash, protect yourself from the inevitable downturn. This decision feels intelligent, prudent, exactly what a sophisticated investor should do. And initially, it might even work. Markets continue higher for a while, but you're safely in cash, smug about your discipline. Then one of two scenarios unfolds, both of them bad for you. First scenario, markets crash as you predicted. You feel vindicated. Your timing was perfect. You avoided 20, 30, maybe 40% of losses. Everyone else is panicking. You're sitting comfortably in cash, waiting for the bottom. And this is where it gets interesting. Because now you need to time the re-entry, which is even harder than timing the exit. Markets continue falling. Do you buy now or wait for more downside? They fall another 10%. Was that the bottom, or will they fall further? You wait for certainty, for clear signals that the worst is over. But certainty never arrives. Markets are messy. Bottoms don't announce themselves. By the time you feel confident enough to reinvest, confident that the coast is clear and recovery is underway, the market's already up 25 or 30 or 40% from the lows. You avoided the full downside but missed most of the recovery. So you got the direction right. You knew a crash was coming, but your net result is worse than if you'd simply held through the entire cycle. You sold high and bought higher. Congratulations. You're poorer for being smart. Second scenario is even worse. You raise cash to avoid the crash, and the crash never comes. Markets just keep rising. Up another 10%, 20%, 30%. And you're sitting in cash earning nothing, watching everyone else get richer while you wait for a correction that refuses to arrive. Eventually, the psychological pain of missing out becomes unbearable. You capitulate. You reinvest at much higher prices than where you sold, having guaranteed a loss through your cleverness. This happens constantly. I watched it happen in the 1990s with people who got scared in 1995, 1996, 1997, convinced markets were overvalued. They were right. Markets were overvalued. But markets stayed overvalued and kept rising for years. The people who got out early lost fortunes in opportunity cost. The arithmetic here is absolutely devastating, and most people have never actually looked at the numbers. Studies show that missing just the 10 best days in the market over multi-decade periods cuts your returns in half or worse. 10 days out of approximately 10,000 trading days over 4 decades. Missing 0.1% of trading days destroys 50% of your returns. That's how concentrated gains are in markets. They don't happen smoothly. They happen in explosive bursts, typically during periods of maximum chaos and uncertainty, exactly when everyone is scared and sitting in cash. And you can't know in advance which 10 days those will be. They're unpredictable. They often follow catastrophic days. The best days frequently occur within weeks of the worst days. So if you're trying to time the market, trying to avoid the bad days, you're almost guaranteed to miss the best days too, because you can't distinguish them in real time. You're trying to get out during chaos and get back in during calm. But the best gains happen during the transition from chaos to calm, and that transition doesn't announce itself politely. So what happens practically? You're sitting in cash, waiting for the all-clear signal, waiting for consensus that the worst is over. And by the time consensus forms, the market's already up 30%. You've missed the entire recovery trying to avoid the last 10% of the downturn. Mathematically, this is catastrophic. You'd have been better off simply holding through the entire cycle, taking the full hit on the downside, but capturing the full recovery on the upside, because over full cycles, markets trend upward. They have to, because businesses create value, economies grow, and stock prices ultimately reflect business value creation. Warren and I watched this play out countless times over 7 decades. Smart people, sophisticated investors, getting out at what they thought was the top, then struggling desperately to get back in. They'd sell at what seemed like reasonable valuations, then watch prices climb another 20 or 30% before the crash finally came. So they were right about the crash eventually happening, but wrong about the timing. And being wrong about timing meant they lost money anyway, because they missed gains that more than offset the eventual drawdown. This is the trap. You can be directionally right and still lose money if your timing is wrong. And timing is always wrong because it's fundamentally unpredictable. Here's the better approach, and it's boring. Stay invested, always, regardless of market conditions, regardless of valuations, regardless of how scared you feel or how certain you are that a correction is coming. Just stay invested. But here's the critical part that makes this approach different from blind optimism. Maintain dry powder. Cash reserves beyond your emergency fund. Not dead money sitting idle. Option money. Capital that gives you the ability to act when others can't. This is anti-fragility in practice. Normal times, you invest normally. Crisis times, you invest aggressively. Not because you timed the bottom, but because you're capitalized and prepared while everyone else is forced to sell. Berkshire Hathaway maintains tens of billions of dollars in cash, sometimes over 100 billion. And financial media constantly criticizes this. They call it inefficient, a drag on returns. Proof that Warren's lost his touch, that he can't find opportunities anymore, that the company's too big to deploy capital effectively. All of this is nonsense. Complete misunderstanding of what cash represents and why we maintain it. We don't hold cash because we're scared. We're not market timers trying to predict crashes. We're not pessimists waiting for catastrophe. We hold cash because we want to be prepared when extraordinary opportunities arrive, which they always do eventually. And those extraordinary opportunities always, without exception, arrive during periods of maximum chaos. When everyone else is panic selling, when forced liquidations are happening, when blood is running in the streets, metaphorically or literally, that's when truly great investments become available. Not during calm markets, not during bull runs, during panics. And you can't capitalize on panics if you're fully invested. If every dollar is deployed, you're not a buyer during crashes. You're either a holder, watching your wealth evaporate, or a seller, getting liquidated along with everyone else. Neither position creates wealth. But if you're capitalized, if you maintain meaningful cash reserves beyond your emergency fund, you're positioned to be the buyer when everyone else must sell. You're acquiring wonderful businesses at terrible prices, and those investments, made during maximum chaos, compound for years afterward, decades afterward. They're the investments that create generational wealth. Let me give you a concrete example from our history. In 2008, during the absolute peak of financial crisis panic, when the entire banking system appeared to be collapsing and even blue-chip companies couldn't access credit markets, we had capital available, massive amounts of capital, and we deployed it aggressively, not trying to time the bottom, not waiting for the all-clear signal, just buying obviously good businesses at obviously distressed prices. We invested billions in Goldman Sachs, General Electric, Bank of America, not because we thought they were risk-free, because we thought they'd survive and the terms we negotiated compensated us enormously for the risk we were taking. Those investments generated tens of billions in profits over the following decade, and they were only possible because we had dry powder available. If we'd been fully invested in 2007, chasing every marginal opportunity, we wouldn't have had capital available in 2008. We'd have been forced sellers along with everyone else, or at best forced holders, watching positions deteriorate. But because we had cash, because we'd been patient and waited, we could act. We could be greedy when others were fearful. And that's where real wealth gets created. Most people do exactly the opposite. During bull markets, when confidence is high and prices are elevated, they're fully invested, using margin, levered to maximize returns. They see opportunities everywhere. Everything looks attractive. Every dip gets bought. They're optimizing for the environment they're in, which is calm and rising markets. This feels intelligent, sophisticated, exactly what successful investors should do. And then crashes come. Suddenly, nothing they own is working. Prices are collapsing. Margin calls are arriving. They need to raise cash to meet obligations or living expenses. So they're forced to sell into the crash, often at the worst possible prices. And when markets finally stabilize and attractive opportunities appear, buying wonderful businesses at 50 or 60 cents on the dollar, they can't participate. They're out of capital. They're psychologically destroyed. They're focused on recovery, not opportunity. and they miss the very moment when the greatest wealth creation opportunities arrive. This guarantees buying high and selling low. Guarantees it. You can't fight this pattern if you're always fully invested. The pattern is structural, not psychological. If you have no cash when crashes come, you're forced to be a seller. You have no choice, and forced sellers get terrible prices, always. Because the buyers know you're forced. They know they have leverage. They're not being generous. They're paying the minimum necessary to pry assets away from desperate sellers. But if you maintain dry powder, if you design your finances so that you're never forced to sell, you become the buyer. You're the one offering 50 cents on the dollar for businesses worth 100 cents. You're the one capitalizing on other people's panic. And this isn't cruel or exploitative. It's rational capital allocation. You're providing liquidity when it's scarce, buying businesses that need capital, performing a necessary market function, and getting paid extraordinarily well for doing it. Here's how to implement dry powder properly in your personal finances. First, maintain an emergency fund for personal expenses. 6 to 12 months of living costs in cash or near cash equivalents. This is baseline, non-negotiable. This fund protects you from forced liquidations during personal emergencies, medical issues, job loss, major repairs. Whatever life throws at you, you have cash to handle it without selling investments at bad prices. That's defensive dry powder. Beyond your emergency fund, maintain an additional reserve for opportunistic investing. Offensive dry powder. How much depends on your situation, your risk tolerance, your ability to generate income. But 10 to 20% of your portfolio in cash or short-term treasuries isn't unreasonable. Will you underperform during bull markets because of this cash drag? Slightly. Your fully invested peers will outperform you when markets are rising. You'll look conservative, too cautious, maybe even foolish for leaving money on the table. None of that matters. What matters is surviving crashes intact with capital to deploy. Because over full cycles, survival plus opportunism beats pure optimization. The people who optimize for bull markets die in bear markets. Their compounding gets interrupted. They spend years recovering, and dead capital doesn't compound. But if you maintain dry powder, you survive crashes with capital available. You buy when others sell. And those opportunistic investments, made during maximum pessimism, generate the majority of your long-term return. The timing on deploying dry powder doesn't need to be perfect, and this is critical to understand. You're not trying to catch the bottom. That's impossible. That's market timing again. You're trying to buy good businesses at obviously distressed prices. When the market is down 30, 40, 50% from highs and everyone is panicking, start buying. Not everything at once. Incrementally, dollar cost averaging into the chaos. As prices decline further, buy more. You're averaging in during turbulence. And if you're wrong and prices keep falling, you still have reserve capital. You're never all in. You're always prepared for worse. This is anti-fragility. This is the operating system that turns market chaos into wealth creation opportunity. Normal times, normal investing. Crisis times, aggressive investing. Always maintaining the ability to act. Always preserving optionality. And optionality during chaos is worth more than the returns you're missing by holding cash during calm, because chaos arrives eventually. Always. And when it arrives, you want to be positioned to capitalize, not positioned to survive. Now we need to talk about something uncomfortable but absolutely critical. Circle of competence under stress. Everything you think you understand about businesses, markets, and investing gets tested during crashes, severely tested. And what you discover, if you're brutally honest with yourself, is that you understood significantly less than you thought you did. Crashes are diagnostic tools. They reveal the difference between what you actually know versus what you only thought you knew, and that distinction is the difference between survival and catastrophe. Circle of competence is the set of things you genuinely, deeply understand, not things you've read about in articles or heard discussed on financial television or picked up from podcasts. Things you could explain in detail to a skeptical expert in the field and have them nod in agreement with your analysis. Things you could defend under hostile questioning. Things you understand so thoroughly that you can predict how they'll behave under stress, not just during calm. For most people, for almost everyone, that circle is smaller than they think. Much smaller. Maybe 5 or 6 things they truly understand deeply. Everything else is surface knowledge masquerading as understanding. And here's what makes this worse. Under the stress of crashes, your circle shrinks even more. Things you thought you understood reveal hidden complexities, dependencies you didn't see emerge, assumptions you made without realizing turn out to be wrong. And suddenly the business you were confident about becomes opaque. You can't tell if it will survive or fail, can't tell if the current price represents opportunity or warning, can't tell if you should hold or sell. You're paralyzed by uncertainty in exactly the moment when clarity would be most valuable. Let me describe how this plays out practically. During calm markets, during normal times, people invest in things outside their circle of competence and get away with it temporarily. Markets are rising. Prices go up anyway. Everyone makes money. Mistakes get covered up by the rising tide. The business model you didn't fully understand? Doesn't matter. Stock's up 20%. The competitive dynamics you didn't analyze thoroughly? Irrelevant. Momentum carries you. The capital requirements you didn't assess correctly? Who cares? Everything's working. You start to believe you understand more than you do. Confidence grows, position sizes increase, and you're setting yourself up for catastrophic failure. Then crashes come and the tide goes out. Suddenly you discover who was swimming naked, to use Warren's phrase, and it's almost everyone. They were invested in businesses they didn't actually understand, industries they couldn't analyze competently, technologies they couldn't evaluate rationally, restaurants they'd never studied operationally, retailers they'd never examined from a merchandising perspective, technology companies they couldn't assess technically, healthcare businesses they didn't understand regulatorily. And when those businesses got stressed, when revenues declined or costs spiked or financing dried up, they had no framework for determining whether problems were temporary or permanent, whether to hold through adversity or sell before catastrophe. So they panicked, made emotional decisions based on fear instead of analysis, sold good businesses at terrible prices because they couldn't distinguish good businesses facing temporary problems from bad businesses facing permanent decline. And the reason they couldn't distinguish was simple. They were operating outside their circle of competence. They never really understood what they owned. They just owned it because prices were rising and everyone else was buying it, and it seemed like a good idea at the time. The solution is brutal in its simplicity, but psychologically difficult to implement. Stay inside your circle of competence ruthlessly, especially during crashes. If you don't deeply understand a business, if you can't explain how it makes money and why that profit mechanism is sustainable and what could threaten it, then you shouldn't own it, period. Doesn't matter how attractive the price looks, doesn't matter how much everyone else is buying it. If it's outside your circle, it's not an investment, it's speculation. It's gambling, and gambling during crashes is the fastest way to zero. Here's the practical application. Before crashes, when markets are calm and you're thinking clearly, audit your portfolio honestly. Look at each position and ask yourself, do I genuinely understand this business? Could I explain to an expert in this industry why this business will still be valuable in 5 years? Do I know what could kill this business? What risks it faces? What would cause it to fail? If the answer to any of those questions is no or uncertain, sell the position. Now, before the crash forces you to make that decision under stress when your judgment is compromised. And if you're tempted to invest in something outside your circle during a crash because prices are attractive, resist that temptation completely. Attractive prices on businesses you don't understand are not opportunities. They're traps. They're value traps. The price looks cheap because of problems you can't assess. Maybe those problems are temporary, and the price is indeed attractive. Or maybe those problems are permanent, and the business is going to zero. You can't tell the difference because you lack the expertise to evaluate the situation. So any investment decision you make will be based on guessing, not analysis. And guessing with real money during market chaos is financial suicide. Inversion is useful here, and this is a mental model I've used for decades. Instead of asking, what should I buy during this crash? Which is the wrong question. Ask, what would destroy me? Then avoid those paths methodically. What destroys people during crashes? First, leverage destroys them. They're using borrowed money, margin calls arrive, forced liquidation happens. Second, concentration destroys them. Too many eggs in too few baskets. One catastrophic position failure wipes them out. Third, investing outside their competence destroys them. They own things they don't understand, can't evaluate problems rationally, make emotional decisions. Fourth, emotional decisions themselves destroy them. Panic selling. Capitulation. Making major changes to strategy under maximum stress. So eliminate those risks first, before you even think about what opportunities might exist. Get rid of leverage completely. Diversify adequately so no single position can kill you. Sell anything you don't deeply understand, and commit to making no emotional decisions regardless of how scary markets get. Only then, only after you've protected yourself from the major risks, can you start thinking about opportunities. But survival comes before optimization every single time, always. If you survive intact, opportunities will come. They always do. Markets always recover eventually. Businesses always create value over time. But if you don't survive, if you blow up during the crash, recovery doesn't matter. You're not participating anymore. Now let's talk about something technical but essential to implementing these principles correctly. Margin of safety quantified. Not the vague concept that gets thrown around in investment discussions. The actual calculation, the specific methodology. What is this business genuinely worth to a rational private buyer? What's it currently trading for in the market? What's the gap between those two numbers? And is that gap wide enough to protect you from your own analytical mistakes and from the market's chaos? This is how you determine whether something is genuinely attractive or just appears attractive because the price dropped. The calculation starts with intrinsic value, and this is where most people get lost in complexity when the principle is actually simple. You're not trying to determine value to 8 decimal places of precision. That's false precision. You're trying to determine a reasonable range. Conservative estimates. What would someone pay for the entire business if it were available for sale as a private company? You're not valuing the stock. You're valuing the enterprise, the entire business as an ongoing operation. Look at normalized cash flows, not last year's results or next year's projections. What does this business typically earn in normal environments? Strip out one-time items. Ignore temporary spikes or troughs. What's the sustainable earning power? If the business earns $50 million annually in normal times and can sustain that earning power without massive reinvestment requirements, it's worth at least 5 to 7 times earnings to a rational buyer Probably more if it has strong competitive advantages or growth potential. That's 250 to 350 million minimum intrinsic value. Likely higher, but use conservative numbers. Now look at the market capitalization. If the stock is trading at 150 million market cap during the crash, you have a 50% margin of safety at minimum. The market is valuing the entire enterprise at 150 million. You believe it's worth 250 to 350 million minimum to a private buyer. That gap, that discount from intrinsic value, is your protection against mistakes, against being wrong about growth rates, against being wrong about competition, against being wrong about management quality, against being wrong about industry dynamics. If you're buying at 50 or 60 cents on the dollar, you can be wrong about a lot and still make money. The business doesn't need to grow. It doesn't need to improve operations. It just needs to survive and eventually get recognized at fair value. And even if fair value is lower than you estimated, even if you were optimistic about earning power or sustainable returns, you're still protected by that discount. Maybe intrinsic value is only 200 million instead of 300 million. Fine. You still bought at 150 million. You still have a 33% margin of safety even with your mistake. That's the whole point. The margin protects you from errors. During crashes, you get these opportunities regularly. Wonderful businesses with strong balance sheets, predictable cash flows that have been generating profits for decades, durable competitive advantages that aren't going away just because the market's panicking, trading at 60 cents on the dollar, 70 cents on the dollar, sometimes 50 cents or less. Not because the business deteriorated, not because competition intensified, not because the industry changed, because sentiment collapsed, everyone's selling, forced liquidations are happening, tax loss harvesting, margin calls, redemptions at mutual funds, technical selling completely disconnected from business fundamentals. And if you're capitalized and rational, if you've designed your finances to survive chaos and maintain dry powder for opportunities, you can buy these businesses. Not everything available. Not all at once, but incrementally as the margin of safety widens, as discounts deepen. You're building positions in wonderful businesses at terrible prices. And you can sleep well at night because you know that even if you're wrong about several assumptions, you're protected by the gap between price and value. That gap is mathematical. It's not based on hope or confidence or optimism. It's based on what you're paying versus what the business is worth. Here's the discipline required. Don't invest without margin of safety, regardless of how attractive a business seems at its current price. If something's trading at fair value or above, it's not an opportunity for you. It might be an opportunity for someone else with different skills or knowledge or time horizon. But it's not an opportunity for you, because you need protection against mistakes. You need that buffer. Without it, you're exposed to every risk, every change in the industry. Every management misstep, every economic headwind, you have no protection, and investing without protection during volatile markets is gambling, not investing. The hardest part of applying margin of safety discipline is watching opportunities pass that turn out to be correct. A business trading at fair value doubles. You passed. You required margin of safety. There wasn't enough, so you moved on. And you feel stupid watching it double. But this is the wrong way to think about it. You're not trying to capture every opportunity. You're trying to avoid catastrophic mistakes. And over a lifetime of investing, avoiding catastrophic mistakes matters more than catching every winner. The catastrophic mistakes kill you. The missed opportunities just mean you made less money than you could have, but you're still compounding, still in the game, still building wealth. That's the entire objective. Let me synthesize this into a framework you can actually use when markets turn chaotic, when panic is everywhere, when everyone's selling and you can barely think straight because of the noise and fear. 6 principles. Not complicated, simple. But remember what I said at the start. Simple doesn't mean easy. Easy would mean everyone succeeds. They don't. Most fail. And they fail because they can't execute simple principles under stress. First principle. Position size for survival, not optimization. Nothing over 10% of your portfolio. Nothing. Design the system to withstand multiple simultaneous catastrophic failures. Assume you'll be wrong more often than you expect. Assume worse will happen than you planned for. Size accordingly. Second principle. Abandon market timing completely. It's a fantasy. Stay invested always, but maintain dry powder, meaningful cash reserves beyond your emergency fund for opportunistic deployment during chaos. You're not predicting crashes, you're preparing for them. Third principle. Know your circle of competence and stay inside it ruthlessly, especially during stress when everything's confusing and you're tempted to buy things you don't understand just because prices look attractive. If you don't deeply understand it, you don't own it. Period. Fourth principle. Calculate margin of safety explicitly for every investment. Don't buy anything, ever, without knowing what you're paying versus what it's worth and having that gap be wide enough to protect you from significant errors. 40, 50, 60% discounts minimum during chaos, not 10 or 15%. Real margins. Fifth principle. Design for anti-fragility deliberately. Your portfolio, your life, your finances should benefit from chaos, not be destroyed by it. Crashes should make you richer through opportunistic deployment, not poorer through forced liquidation or panic selling. This requires preparation before chaos, not reactions during chaos. Sixth principle. Emotion is the enemy always. Rationality is everything. Make decisions based on mathematics and analysis, never based on how you feel or how scared you are or what everyone else is doing. If you can't be rational during crashes, you'll be destroyed during crashes. Guaranteed. That's the formula. Those 6 principles. They're not exciting. They won't make you rich quickly. They won't generate great stories to tell at parties, but they will keep you from going broke during chaos. And over decades, not going broke plus consistent compounding beats genius plus catastrophic mistakes every single time. No exceptions. I've watched this pattern play out for 70 years across thousands of investors. The survivors aren't the smartest. They're the ones who designed their systems to survive their own stupidity and the market's inevitable chaos. They accepted that crashes are not aberrations. Crashes are features of markets, not bugs. They happen regularly, approximately every 7 to 10 years on average, sometimes more frequently. And they're not predictable. You can't know when they'll arrive or how severe they'll be or how long they'll last. What you can know is that they will arrive eventually, always, without exception. So you prepare, you design your finances assuming chaos is coming, and when chaos arrives, you're not surprised, you're not panicked. You're executing a plan created when you were rational. Let me leave you with a few observations that matter more than any tactical advice. These are things I've learned over 7 decades of watching markets and people and trying, not always successfully, to stay rational myself. Knowing what you don't know is more useful than being brilliant. I mean this literally. The intelligent investor knows the boundaries of their knowledge. The brilliant but overconfident investor thinks they know everything and bets accordingly. And the brilliant investor often loses everything, while the merely intelligent investor who knew their limits survives and compounds. Acknowledging what you don't know is the dawning of wisdom. Most people can't do this. Their egos won't allow it. They'd rather pretend to understand than admit ignorance. But admitting ignorance is protection. It keeps you from making catastrophic mistakes in areas where you have no competence. The big money is in the waiting, not the trading. Patience isn't just a virtue in investing, it's the entire game. The person who can sit still, do nothing, wait for genuinely attractive opportunities will beat the person constantly trading, trying to optimize every small edge. Staying rational yourself means the stupidity of the world helps you. Markets are dominated by emotional decision-making, fear, greed, panic, euphoria. If you can stay rational while others lose their minds, you profit from their emotionalism, but only if you stay rational. If people weren't wrong so often, we wouldn't be so rich. This is just observational truth. Our returns at Berkshire came largely from other people making mistakes, selling wonderful businesses at terrible prices during panics, overpaying during manias. We didn't create the opportunities. Their mistakes created the opportunities. We just had to be capitalized and rational enough to capitalize on them. Go through life anticipating trouble. Be ready to perform adequately when trouble comes. Don't expect perfection from yourself. Don't expect to always make the right decision. Expect mistakes. Expect adversity. Expect chaos. And design your finances to soldier through regardless. Because soldiering through is the whole game. The people who survive are not the ones who avoid adversity. They're the ones who endure it without quitting or making catastrophic mistakes under pressure. These aren't clever sayings I invented. They're observations from 7 decades of watching markets, watching people, watching what works and what fails. The patterns repeat endlessly because human nature doesn't change. Markets don't change fundamentally. What changes is who survives and who doesn't. And survival, as I've said repeatedly, isn't about predictions. It's about principles. About preparation rather than precision. About designing systems that work under stress, not just in calm. That's the entire lesson. Everything else is noise.